So this is an exercise from the book. The following income statement information about changes in non-cash and non-activities are here, but here's our income statement. And then instead of us getting two balance sheets, we were just told the increases and decreases. So how would we go about calculating this? And so I'm recording this so you can go back and practice this by yourself. Try to calculate it yourself and see if you get the correct answer. So how do we calculate this indirect method statement of cash flows? Well, first we're going to start with everything. We're always going to start the same using the indirect method. Indirect method, we're going to start with net income. 481, 540, 481, 550, 540. So that's where we're getting the beginning of the statement of cash flows from. Then we're going to add back non-cash expenses. What are our non-cash expenses? Our non-cash expenses here are our depreciation expense and our amortization expense. So we're adding back those two pieces. Is there any other non-cash expenses or gain or losses? When we see on our income statement, we also have a gain from a sale of equipment. Well, gain we're going to reduce because gain increases net income but doesn't necessarily have a cash impact. So we're going to reduce that gain on sale of equipment here, 6.2 thousand. So this would be our non-cash item reconciliation. Then we would go and see our changes. And so we don't have balance sheet here, two balance sheets or comparative balance sheets, right? So instead we just see our increases and decreases, which are provided for us. We have an increase in accounts receivable, which means that we didn't collect this cash, but we treated it as revenue. So we decrease it. You can also use this chart to give you an example. We had an increase in our current asset, so we decrease it from net income. That's how we use that table. Increase in merchandise inventory. So we have an increase in our inventory. That means we didn't sell it. It also means we didn't. It also means that it was included. It was capitalized, but not included in expense, but we paid cash for it. Other way to think of it is it's a current asset. It increased, right? Changed in the balance, increased, and so we're going to subtract it from net income. We had a decrease in accounts payable. If we think about that, that means we paid for accounts payable that wasn't included in net income. Right, so we debited accounts payable, credited cash for $12,500. The other way to think about it is decrease in current liability, you subtract from net income. And then same thing with salaries payable, right? That's a decrease in a current liability, so we're going to subtract it from net income. Another thought of that is we expensed it in a prior period. In the current period, we paid cash out, and so we're going to have to adjust our net income. We're going to take all of that amount, 44200 plus 4200 minus 6200 minus 30,500 minus 25,000 minus 12,500 minus 35,000, and then add that to our total, and we get our net cash provided by operating activities at 452,240. And that'd be the answer. That's how you compare this. You're going to have homework questions like this so you can understand it, and you might get asked a question of how to calculate the net cash provided by operating activities, but I wouldn't ask you to write this whole statement out. And then from a business perspective, right, from a financial analysis perspective, I'd want to make sure we understand when we're looking at this, we can see that, well, the company had a net income of almost $500,000. We decreased it by $30,000. And the primary reasons for that decrease was because we increased our accounts receivable and we increased our inventory. So we have more inventory now, and then it looks like our customers may not be paying as much, paying as timely as they used to. And so from an analysis perspective, this is very useful to see how the company is operating. Here's another one I could flashcard, right? Another way to think about this, we can take our cash flows from operating activities, we start with our income, then we add back our non-cash expenses, subtract non-changes. So just another way to visualize it. Feel free to use whatever works best for you. And then this is what it would look like at the end. This is an example of what it would look like. We have our net income, we have our reconciling items, and then we have our increases and decreases. Why would we subtract a gain? Well, the gain, the logic behind it, right? Know that you have to do it. Just memorize that. The logic behind it is that that gain increased income, right? But we're going to treat the whole sale of the asset as an investing activity. If we sell a long-term asset, it's going to increase our investing activity. It'll be a cash inflow from investing for the full amount. But the gain will be captured in net income. So we to get our operating correct, that gain is not an operating activity. So we need to reduce the gain from the net income so our operating activities are correct, and then the full amount of receipt will be part of our investing activities.